When people ask whether real estate is a good investment, they're usually asking the wrong question. The more useful question is whether real estate is a productive use of capital in the world we actually live in today. Given the technologies we have, the problems we face, and the constraints that shape how value is created, that distinction matters because investing isn't just about earning returns. It's about deciding where scarce resources can do the most good over time. Real estate has a long history as a store of value. It feels tangible, stable, and understandable. You can see it, touch it, and point to it on a map. But those qualities can also obscure something important. Most real estate investment doesn't fundamentally increase the productive capacity of the economy. In many cases, it reallocates existing value rather than creating new value. That doesn't make it immoral or irrational, but it does make it limited. When you step back and look at progress over the last century, the biggest gains in human well being didn't come from owning more land or nicer buildings. They came from systems that scaled knowledge, health, and productivity. Electricity, computing, vaccines, logistics, education. These advances didn't just shift wealth around, they expanded what societies could do. They lowered costs, extended lives, and opened opportunity to people who previously had none. Real estate, by contrast, is constrained by geography, regulation, and physical limits. A building can only serve so many people. A city can only densify so far before congestion, politics, or infrastructure intervene. And while innovation can improve efficiency at the margins, it rarely transforms the underlying economics in the way software or biotechnology can. Another challenge is that real estate markets are often optimized around predictability rather than progress. Investors value stable cash flows, low volatility, and familiar financing structures. That preference makes sense individually, but systemically, it pushes capital toward assets that look safe rather than toward solutions that solve hard problems. Over time, that trade off matters. There's also a tendency to confuse historical performance with future usefulness. Real estate has done well in many periods, largely because of demographic growth, falling interest rates, and favorable tax treatment. Those are conditions, not laws of nature. And so when they change, and they do, the assumptions behind those returns weaken. So the real question isn't whether real estate can make money. Of course it can. The question is whether, in a world facing climate risk, demographic shifts, and rapid technological change, allocating more talent and capital to this space actually moves us forward. If the goal is long term resilience and broad based progress, we have to be willing to examine not just what works financially, but what works systemically. That's the lens this conversation needs. Not ideology, not nostalgia, but evidence, incentives, and impact at scale. To understand why real estate so often disappoints as a long term engine of value creation, you have to look closely at how the system actually functions, not how it's described in brochures or investment decks, but how information, capital, and incentives move through it in practice. At its core, modern real estate is a highly intermediated market. Transactions involve brokers, lenders, appraisers, lawyers, insurers, regulators, and tax authorities. Each layer adds cost, but more importantly, each layer standardizes behavior. Over time, this produces markets that are surprisingly efficient at pricing known risks. When a Class A office building in a major city changes hands, dozens of professional actors are modeling the same cash flows. They can see assumptions and financing costs. They may disagree at the margins, but they're operating from a shared playbook. That's why true mispricing is rare in developed markets. Information asymmetry, One of the classic drivers of outsized returns has steadily eroded. Data on rents, sales, occupancy, and financing is widely available and increasingly real time. Sophisticated modeling tools are no longer confined to elite firms. Even mid sized investors now operate with analytics that would have been considered advanced a generation ago. As a result, prices tend to reflect consensus expectations quickly, even when those expectations turn out to be wrong. And this creates an important distinction. Markets can be efficient without being correct. A group of rational actors can agree on assumptions that later prove false. But the key point is that disagreement rarely shows up in price in a way that allows disciplined investors to systematically exploit it. You're not competing against ignorance, you're competing against other professionals with similar data, similar incentives, and often similar constraints. Those constraints matter. Real estate is capital intensive, slow to adjust, and highly dependent on financing conditions. Changes in interest rates ripple through the system with outsized force. A modest increase in borrowing costs can dramatically alter valuations, not because buildings changed, but because the math did. This sensitivity makes returns highly dependent on macroeconomic conditions rather than operational excellence. There's also the question of scalability. Unlike software or manufacturing, where improvements can be replicated at near zero marginal cost, real estate improvements are local and incremental. A well managed property doesn't become 10 times more valuable because of a better process. It becomes slightly more efficient, slightly more attractive, slightly more profitable. Those gains matter, but they don't compound in the same way innovation does elsewhere. Another defining feature is liquidity, or rather, the lack of it. Real estate markets appear stable, partly because prices don't update continuously, transactions take months, sometimes years. That smooths volatility on paper but concentrates risk beneath the surface. When conditions change, adjustments can be abrupt and painful because there's no gradual repricing mechanism. All of this shapes behavior. Investors gravitate toward familiar asset types, not because they're superior, but because the system rewards predictability. Financing is easier, benchmarks are clearer, career risk is lower over time. That reinforces homogeneity in decision making and discourages experimentation. From a systems perspective, this is the core limitation. Real estate markets are designed to preserve value, not to discover new ways of creating it, and that makes them useful for certain purposes, but poorly suited as engines of broad economic progress. Understanding that distinction is essential before deciding where capital and attention should go next. One of the most underappreciated forces shaping investment outcomes isn't talent, insight, or even discipline. Its structure, the rules embedded in tax codes, legal entities, and financial systems often matter more than the intelligence or effort of the people operating within them. Nowhere is this clearer than in real estate. From a distance, real estate looks like a business of judgment, finding the right location, negotiating well, managing efficiently. But when you look closely, returns are heavily determined by how income flows through the system and how much friction it encounters along the way. Taxes, in particular, quietly dictate who can compete and who cannot. For large corporations, especially traditional C corporations, real estate is structurally disadvantaged. Income generated by property is taxed at the corporate level and then taxed again when distributed to shareholders. That double layer fundamentally alters the economics. It doesn't matter how well managed the asset is, the math works against you before operational skill even enters the picture. Other structures, partnerships, REITs, private ownership, avoid much of this friction. They allow income to pass through more efficiently, often with favorable depreciation treatment and flexibility in how returns are realized. And over time, those advantages compound. Two investors can own identical buildings, operate them equally well, and still end up with very different outcomes simply because of how the income is taxed. This isn't a moral judgment or a loophole. It's a design choice embedded in policy, but it has consequences. It means that large, diversified corporations are often competing in markets where the rules tilt against them from the start. No amount of operational excellence can fully compensate for that. What's important here is not the technical detail, but the broader lesson. Incentives shape behavior more reliably than intentions. And when the system rewards certain structures, capital flows toward them. When it penalizes others, even highly capable organizations step aside. Over time, this shapes entire markets, determining who participates and how competitive those markets become. This dynamic also explains why real estate tends to attract capital that is optimizing for tax efficiency rather than innovation. The goal becomes preservation and predictability, not experimentation or transformation that's rational behavior within the system, but it also limits the kind of progress that can emerge. From a societal perspective, this matters because capital is finite. Every dollar allocated to navigating tax structures is a dollar not spent on solving problems like clean energy, disease prevention, or scalable education. The issue isn't that real estate is unproductive, it's that the system rewards it in ways that may not align with broader priorities. Over time, this misalignment compounds. Capital flows toward areas where returns are protected rather than created. Risk taking shifts from building new capabilities to optimizing around existing rules. Innovation slows not because people lack ideas, but because the incentives quietly steer effort elsewhere. Understanding this helps explain why smart, disciplined investors can rationally avoid entire sectors. It's not about pessimism or lack of imagination. It's about recognizing that structure often overwhelms skill, and that sustainable progress requires aligning the two, not fighting the system as it exists. Periods of crisis tend to dominate how people remember real estate investing, largely because they create the illusion that extraordinary returns are always just one downturn away. When markets seize up, prices fall sharply, and stories emerge of investors who stepped in at exactly the right moment. These stories are real, but they're also deeply misleading if treated as a repeatable model. Crises don't create opportunity in the way innovation does. They temporarily expose fragility in systems that were already under strain. During moments like the savings and loan collapse or the financial crisis, asset prices didn't fall because buildings suddenly became less useful. They fell because financing vanished, regulatory structures failed, and forced sellers overwhelmed the system. Liquidity, not value, was the constraint. What made those periods unusual wasn't insight, it was dysfunction. Owners who didn't want to sell were compelled to lenders that normally would have extended credit couldn't. Information broke down, decision making became fragmented. In that environment, capital with patience and flexibility could step in. But that opportunity existed precisely because the system had stopped functioning normally. This is an important distinction. You can't build a long term strategy around dysfunction without assuming repeated systemic failure. That's not investing, that's speculation on instability. Most institutions are not designed to operate effectively. In those conditions, governance processes slow down, risk tolerance shrinks, public scrutiny increases. Even when opportunities exist, few organizations are structurally prepared to act. There's also a survivorship bias in how these periods are remembered. We hear about the deals that worked, not the many that failed or barely broke even. Real estate acquired during crises often requires years of capital, management, attention, and patience before outcomes are known. Those holding costs rarely show up in simple return calculations. More importantly, crisis driven investing doesn't scale. The very conditions that make assets cheap, panic, illiquidity, regulatory confusion, also limit the amount of capital that can be deployed productively. Once stability returns, the opportunity disappears. That's not a foundation for sustained impact or long term planning. From a systems perspective, relying on breakdowns to generate value is a sign of inefficiency, not opportunity. Healthy systems produce value through continuous improvement, not episodic distress. If your investment thesis depends on things going wrong, you're not contributing to resilience. You're betting against it. This is why experienced capital allocators are cautious about narratives built around the next crisis. They understand that timing these moments is extraordinarily difficult and that institutional constraints often prevent action precisely when speed matters most. It's also why many organizations, after experimenting during chaotic periods, choose not to repeat the experience. The deeper lesson is that sustainable progress doesn't come from exploiting dislocation. It comes from building systems that perform well, even when conditions are stable. That's where innovation, policy design, and long term thinking matter most. Crises may reveal weaknesses, but they rarely offer a reliable blueprint for what comes next. In the context of real estate, this reinforces a simple conclusion. If value only appears when the system breaks, the system itself is not a foundation for enduring growth. One of the most persistent beliefs about real estate is that it offers stability. Rents are steady, buildings last decades, people always need places to live and work. On the surface, this logic feels sound, and it's reinforced by the way real estate values tend to move slowly compared to stocks or commodities. But that sense of stability is often an illusion created by delayed feedback rather than true. Resilience in most markets, prices don't update continuously, transactions are infrequent, negotiations are private, and valuation methods rely heavily on assumptions about future cash flows. This smooths volatility in the short term, but it doesn't eliminate risk. It merely hides it. When conditions shift, adjustments happen all at once. That's why real estate downturns often feel sudden and severe, even though the underlying pressures have been building quietly for years. Leverage amplifies this effect because real estate is typically financed with large amounts of debt. Small changes in income or interest rates can produce outsized changes in equity value. A modest increase in borrowing costs can erase years of appreciation. Yet during periods of stability, leverage feels safe, even prudent. So that's how false confidence forms, not through recklessness, but through long stretches where nothing appears to go wrong. So this dynamic creates a feedback loop, and perceived stability attracts more capital. More capital compresses returns. Lower returns encourage higher leverage increases fragility. And because the system doesn't provide frequent warning signals, participants often underestimate how tightly coupled these risks have become. There's also a broader economic cost to this kind of stability seeking behavior. When large amounts of capital chase assets designed to preserve value rather than expand it, overall productivity growth slows. Resources that could support innovation, infrastructure, or human capital instead reinforce existing structures. The economy becomes more efficient at maintaining the status quo, but less capable of adapting to new challenges. This is especially important in a world facing structural change. Climate risk, demographic shifts, and technological disruption all require flexibility and experimentation. Systems optimized for predictability struggle, Under those conditions, they're slow to reallocate capital, slow to adapt, and often resistant to change because so many stakeholders depend on the existing equilibrium. The irony is that what feels safe at the individual level can increase systemic risk. When everyone seeks stability in the same places, the system becomes brittle. Diversity of investment across sectors, time horizons, and problem spaces is what creates resilience. Concentration, even in assets perceived as conservative, does the opposite. This doesn't mean real estate has no role. Stability has value. Long-lived assets support communities and economic activity. But stability should be a foundation, not a destination. When too much capital chases predictability, society underinvests in progress. Understanding this distinction helps explain why real estate can appear attractive while quietly limiting long-term growth. It also explains why economies that overemphasize asset preservation often struggle to generate the kind of innovation needed to meet new challenges. Stability without adaptability isn't safety, it's stagnation. When you look across history, the most transformative investments share a common feature: they scale, not just financially, but socially, economically, and technologically. They reduce costs over time, expand access, and improve outcomes for more people with each iteration. This is where the contrast with real estate becomes clearest, not as a critique of buildings, but as an observation about where compounding truly happens. In sectors like software, biotechnology, energy, and data infrastructure, progress follows learning curves. Each improvement builds on the last. Costs fall as knowledge accumulates, performance improves as feedback loops tighten. When a vaccine platform gets better, millions benefit. When computing power doubles, entirely new industries emerge. These systems reward experimentation because small breakthroughs can scale globally. Real estate doesn't behave that way. A better designed building benefits its occupants, but the improvement doesn't propagate outward. It doesn't reduce the cost of the next building or fundamentally change how cities function. Even innovative construction techniques tend to diffuse slowly, constrained by regulation, local conditions, and fragmented ownership, and the ceiling on impact is relatively low. This difference matters because capital doesn't just fund assets, it shapes the future. When investment flows towards scalable innovation, societies become more productive. When it concentrates in assets that primarily store value, growth slows, even if wealth appears to rise. The distinction is subtle but critical. Take technology platforms as an example. Once built, software can serve millions at near zero marginal cost. That property allows experimentation at a scale that physical assets simply can't match. A single insight can be tested, refined, and deployed globally in months. Failures are cheap, learning is fast. Over time, this produces exponential improvement. Healthcare offers another illustration. Investments in vaccines, diagnostics, and data systems don't just generate returns. They reduce disease burden, increase life expectancy, and strengthen economic resilience. The benefits spill across borders and generations. These are positive sum outcomes where success multiplies value rather than redistributing it. Energy systems tell a similar story. Advances in renewables, storage, and grid management reduce costs while improving reliability. Every efficiency gain compounds. Once the infrastructure is in place, the marginal cost of clean energy approaches zero, reshaping entire economies. What unites these examples is that progress is cumulative. Knowledge compounds. Systems learn, the return on investment increases over time rather than decaying. That's fundamentally different from assets whose value depends on scarcity, location, or financial engineering. This doesn't mean real estate is irrelevant. Cities matter, housing matters, infrastructure matters, but the highest leverage comes not from owning the assets themselves, but from improving how they function through better materials, smarter planning, digital coordination, and evidence-based policy. Those improvements often come from outside the real estate sector itself. The challenge is that these opportunities don't always look safe in the short term. They require patience, tolerance for failure, and a willingness to invest before returns are obvious. They also demand collaboration between the private sector, governments, and research institutions. That complexity can be uncomfortable, especially compared to the apparent simplicity of owning physical assets. Yet history is clear. Societies that invest in scalable systems outperform those that invest primarily in preservation. Productivity growth isn't automatic. It's a result of deliberate choices about where talent, capital, and attention are directed. The real question, then, isn't whether real estate can generate acceptable returns. It's whether focusing too heavily on it crowds out investments that could deliver far greater benefits over time. In a world facing climate change, demographic pressure, and technological disruption, and that opportunity cost is no longer abstract, capital that accelerates learning, resilience, and adaptability doesn't just earn returns, it expands what's possible. That's where progress compounds, and that's where the most meaningful long term investments tend to be made. When we talk about investment choices, it's easy to frame them as neutral preferences, one asset versus another, one strategy versus the next. But at a systems level, choosing where not to invest can matter just as much as choosing where to invest. Capital doesn't sit idle. When it concentrates in low productivity uses, the cost isn't just financial, it's societal. Every dollar allocated to preserving existing value is a dollar not spent to expanding future capacity. That trade off often goes unnoticed because the effects are diffuse and delayed. We don't see the cancer treatment that wasn't developed, the energy system that wasn't modernized, or the educational breakthrough that didn't scale. But over time, those absences accumulate into slower growth, reduced resilience, and fewer options when crises emerge. This matters especially in an era defined by compounding challenges: climate change, aging, populations, health system strain, and geopolitical instability are not problems that resolve themselves. They require sustained investment in innovation, infrastructure, and institutional capability. When capital flows disproportionately into assets designed to preserve wealth rather than generate solutions, societies lose momentum precisely when adaptability matters most. There's also a generational dimension. Younger populations inherit the consequences of today's capital allocation decisions. If investment skews towards scarcity-based assets rather than capacity-building systems, future generations face higher costs and fewer opportunities. Housing becomes less affordable. Energy transitions slow. Productivity gains flatten. These outcomes aren't inevitable. They the result of cumulative choices. Importantly, this isn't about assigning blame. The individuals making these decisions are often acting rationally within the incentives they face. Pension funds seek stability. Corporations optimize after tax returns. Investors respond to risk signals. The problem is systemic. When many rational decisions align in the same direction and they can collectively produce suboptimal outcomes, this is where policy, governance, and long term thinking become essential. Markets are powerful tools, but they don't automatically account for externalities, long time horizons, or public goods. Without thoughtful design, they tend to overweight near term certainty and underweight long term resilience. The cost of standing still is rarely visible in quarterly reports, but it shows up over decades in lost competitiveness and declining opportunity. Economies that fail to invest in innovation eventually find themselves managing decline rather than shaping growth. Reversing that trend becomes increasingly difficult as institutional capacity erodes. The encouraging part is that this trajectory isn't fixed. History shows that societies can redirect investment when incentives change and when leadership aligns around clear priorities. The challenge is recognizing that inaction carries its own risks and that maintaining the status quo is often the most expensive choice of all. Understanding this reframes the conversation about real estate and capital allocation. The question isn't whether certain investments are safe, it's whether they help build a future that's more capable, more resilient, and more equitable than the present. And when viewed through that lens, the cost of standing still becomes impossible to ignore. If there's one lesson that emerges from looking at real estate through a systems lens, it's that progress doesn't come from rejecting entire asset classes. It comes from aligning incentives with outcomes that actually matter. The goal isn't to abandon stability or dismiss the role of physical assets. It's to design systems where stability supports innovation rather than competing with it. A more productive path forward starts with acknowledging that markets reflect the rules we give them. When capital repeatedly flows into low productivity uses, it's rarely because investors lack imagination. It's because the system quietly rewards preservation over progress. So, changing that requires intentional design policy frameworks that encourage long term value creation, regulatory environments that reduce friction for experimentation, and financial structures that make it easier to invest in outcomes rather than assets. This doesn't mean picking winners or centralizing decision making. In fact, the most effective systems do the opposite. They create conditions where many experiments can happen, where failure is informative rather than fatal, and where success can scale. Governments play a role by funding basic research, modernizing infrastructure, and setting clear, predictable rules. The private sector contributes by turning ideas into scalable solutions. Civil institutions help ensure that the benefits are broadly shared. Data plays a crucial role here. Better measurement allows us to see what's actually working, not just financially but socially and environmentally. When outcomes are visible, capital can move more intelligently. This is especially important in areas like energy, health, and education, where returns unfold over long horizons and traditional metrics often fall short. There's also an opportunity to rethink how we define risk. Too often, risk is framed narrowly as short term volatility, but long term stagnation is a far greater threat. Systems that avoid all uncertainty tend to lock in inefficiency. Resilient systems, by contrast, absorb small failures in order to avoid large ones. They learn, adapt, and improve. For investors, institutions, and policymakers alike, this requires a shift in mindset. The question becomes less about protecting what exists and more about enabling what's possible. That doesn't mean abandoning prudence, it means broadening the definition of value to include learning, adaptability, and long term benefit. Real estate will continue to play a role in economic life. People will always need places to live, work, and gather. But the future won't be shaped by the assets that simply endure. It will be shaped by the systems that evolve. Progress is always dependent on our willingness to invest ahead of certainty, to build capacity before demand is obvious, to support innovation before returns are guaranteed, and to think in decades rather than quarters. When capital, policy, and purpose align around that principle, the results can be extraordinary. That's the opportunity in front of us, not to abandon what works, but to ensure that what works today doesn't crowd out what could work far better tomorrow. When you step back and look at how meaningful progress actually happens, a pattern becomes clear. It rarely comes from optimizing what already exists, it comes from expanding what is possible. Societies move forward when they invest in capabilities that compound knowledge, health, energy, and institutions that learn over time. Real estate, in that sense, is not a villain, it's a foundation, but foundations are meant to support growth, not replace it. When too much attention and capital are directed toward preserving existing structures, the system gradually loses its ability to adapt. Growth slows, resilience weakens, and opportunities narrow. That's not a failure of individuals or markets. It's the natural outcome of incentives that favor stability over exploration. The most important advances of the past century came from people willing to invest before outcomes were certain, funding basic science, building infrastructure ahead of demand, and supporting technologies that initially looked impractical. Those investments required patience and trust in long term returns, but they reshaped the world in ways that short term optimization never could. The same principle applies today. The challenges we face, climate change, health resilience, demographic shifts, technological disruption, cannot be solved by reallocating existing assets alone. They require new capabilities, new tools, and new ways of organizing effort. So that's where progress still compounds. And the opportunity now is to design systems that make this kind of investment easier and more attractive. That means aligning incentives with long term outcomes, using data to guide decisions, and building institutions that reward learning rather than mere preservation. It also means recognizing that stability and progress are not opposites. They depend on each other when designed well. Real estate will continue to play a role in the global economy as it should, but the future will be shaped less by what we own and more by what we enable. When capital, policy, and purpose align around that idea, progress stops being episodic and starts becoming durable. That's ultimately the measure of a healthy system, not how well it protects the present, but how effectively it prepares for what comes next.